Jason, how long have we been doing this?
Too long to not discuss who's doing the intro.
Well, but I want to give a little golf clap to Jack here. Finally, we got the music after the countdown.
Yeah.
That's big. That's big.
Well,
this show is hitting new levels. New levels of production, new levels of content, new levels. I can't say quality. Maybe the quality might be dipping, honestly.
Except for you don't. I'm feeling behind the scenes. I was actually trying to get our intro music up so I could have it quietly play in the background while you ramped up in today's intro. So I was like trying to figure that out. But I'm failing right now.
Again, I like having goals and objectives for this show, so we can keep iterating, keep working towards it. Welcome everyone. It is Friday, June 17th, and this is Pirates of Finance. We're your co-hosts, Jason Buck. Oh, I did it right the first time. I'm Corey Hoffstein, behind the scenes. The man on what Jason calls the ones and twos is our man Jack Farley. He's going to be guiding us, DJ Jack Farley. He's going to be guiding us on a little adventure today, asking us a series of questions that Jason and I have no idea what they are, haven't prepared for. We're going to answer off the cuff. But before we do that, Jason, I have a question for you. Is business travel back? Because I hope not.
Based on the price of flights, at least travel's back. I don't know how much business travel. I think technically it's down, but you say that because you had did you spend more time on the tarmac or in the air over the last few days?
That's a great question. I think between airports, tarmac, and hotel rooms, I'll leave it at that. I mean, I guess all I can say, I've heard worse horror stories over the last 6 months. It does seem like everyone I'm talking to is hitting more delays than they ever have. There just seems to be either a shortage of planes or a shortage of staff or whatever it is. I mean, I was laughing because our friend Rodrigo Gordillo from Resolve, I'm tweeting about being delayed, and the next day he's tweeting about being delayed on the tarmac for 2.5+ hours. And I was hearing someone else was telling me they landed and couldn't find a ground crew to let them off the plane. So they watched 2 movies before they even got off the plane on the tarmac. So yeah, it seems like we have a supply chain issue in the airports right now, is what we're discovering. And my tolerance for it is quite low after 2 years of not traveling.
But my brain always jumps though to the Louis C.K. bit. And then what happened? Did you fly through the air on a magic carpet? Did you time travel? Like everything's amazing and everything's amazing and nobody's happy, right? Like if we would have,
I have had this thought so many times when I go through an airport and I'm going through the TSA line. I'm like, humanity is disgusting. We are awful creatures. Look at us. We're just angry and sweaty and gross. And then as the plane takes off, I'm like, we are just magnificent. We're geniuses. We've conquered flight. We weren't born to fly, but damn it, we invented our way through it.
Well, well, then 2 questions with that. Do you think Zoom culture has then made you more like almost agoraphobic? And then 2, then does that mean in real life stuff has a tremendous amount of value? Because if you're actually now willing to travel and really meet up and meet space, then like that's going to have like an enormous premium on it, like to get you out of the house.
I mean, I'll still travel. I think my tolerance for travel was already going down. I really enjoyed traveling in my 20s. I've seen a huge amount of the country because of work travel, which has been phenomenal. But my appetite for wanting to travel was already dying. You know, I no longer see gold, platinum status on an airline as something, laudable. I'm now like, you have missed major life events sitting on an airline. Like, and I just don't want to do that anymore. And I'm seeing it with other people. I mean, I was chatting with a major CIO who racked up unbelievable amounts of miles flying around the globe. And this person basically said, I didn't even realize the things in my children's life I was missing until I was forced to be home for them. And now I never want to travel again. So, I'm hoping it just sort of forces that work-life balance. I still love getting together with people in person. Can't replace that, breaking bread with someone. Right. But maybe just it's a little more special now.
Most important question of the day. Did you change your light or something? Your eyes are popping today. Did you put on like the Mike Green filter?
Yeah, I was going to say, I definitely put in some contacts. I didn't like the way I looked last week, so I put in some contacts just to get the baby blues popping.
They're glowing.
I don't know what to tell you. The mood lighting just must be right in here.
Yeah, exactly. Well, before
All right.
we better bring in DJ Captain Jack to get us back on track here, because I always look forward to the comments talking about how we just waste an inordinate amount of time just talking to each other.
Yeah, we got Boom Bam saying bring on Jack 3 minutes ago. So
yeah, would you
here
see?
we
By
go,
the way,
Jack.
Menahem has Menahem Sailor as this title today.
Oh, I didn't realize that it wasn't his real name. So yeah, this must have been an incredibly exciting week for both of you, because I know that you two love macroeconomics so much. And Jason, if there's anything that you love more than macro, it's giving advice. So what advice would you have for our audience on how to navigate these choppy markets?
I'm so glad you directed this directly at Jason. Jason, here's the floor. Enjoy.
All right. First of all, like Jack said, zero advice, right? It just boggles my mind for many reasons. But the other thing is, like, I'll address again, I actually don't hate macro as much as people think I do, because I think every great macro, let's set aside systematic macro as a whole different other space where you're using, factors and all that other stuff. Some people would argue that trend following managers are actual global macro. I'm going to set that aside. I'm going to talk about like discretionary macro for a second. And the idea to me is like the best discretionary macro traders in the world are a form of like long volatility traders in a way. Like they're buying leap options. They're like long-term optionality if done right. And so they may have a global macro thesis, but to me, they're actually micro traders, right? They're thinking about how do I implement this? And they're looking at like secondary and tertiary effects. They're looking for ways to implement convexity into the portfolio and optionality. And I think like back in the day, Hugh Hendry said it best, is like he's like a centipede. If he has on 100 trades, he doesn't mind quickly chopping off 10 to 20 of those. If his Bayesian update of like how the world has changed, he needs to get rid of those trades. But more importantly, he can handle the downside of those if you have especially optionality or convexity to the trades. Then if you're wrong, you don't get hurt as much. So what's actually ironic to me is like a global macro trader implementing hundreds of micro trades actually doesn't need to get his global macro thesis right, because it's usually the convex terms of the payment structure of the trades they put on. If they put on a broad swath of trades, the ones that are wrong, you have zero recourse leverage. So, it's convex to the downside as well as convex to the upside. So therefore, they don't have to get the trades right in their macro thesis. If they put on a broad swath of trades and it takes years to play out, and all of a sudden that convexity kicks in, or they're on the other side of the boat, then when most people are leaning to the other side, this is what really makes global macro interesting to me. But part of that is when it's part of its turtles all the way down, in the sense that the punditry or financial media wants to have these people on to give their hero trade. And I don't care about their hero trade. Show me their book. Show me the rest of your book. How is your portfolio hedged? What are all the elements to your book? That will show me actually where your trades are and where you have convexity in the book and where your hedges are and how you're going to change day to day. And then more importantly, on the not giving advice side, is I can't believe, the people that get mad at us in the comments and everything, and they're coming here for answers. I feel sorry for you if you're coming here for answers, because Corey and I don't have any answers. But more importantly, like I would be questioning your cognitive apparatus if you're looking to two yahoos on YouTube for answers. Even if it's the best global macro trader in the world, there's instance after instance after instance. As soon as they come on financial media, they're basically talking the other side of their book. They're crying about market lows. Meanwhile, they're selling that position into retail and they're taking the other side. So there's been that manipulation millions of times over. And then more importantly, if they were even actually telling you the actual trade they have on, you don't know if tomorrow they're going to take that trade off or they're going to have a different trade. They're not calling you up as somebody in the audience to tell you they've changed their position. So the whole landscape, both from the macro traders to the macro financial media to the people that consume it, it just doesn't make sense to me.
There's a lot to digest there, but I just want to make sure I understood that in the first 10 minutes of the show, you insulted our audience's intelligence. I just want to make sure I got
not our audience.
Okay.
I'm trying to make sure we get the right audience, that's looking for two idiots just talking nonsense, because that's exactly what they are. If you're here because you think we're intelligent, we're going to give you the best trade in the world, and you're going to follow our advice, then this is not the channel for you.
Yeah, I mean, I think, right, with any sort of investment strategy, you have the massive storytelling survivorship bias. And I think macro has the best stories of all. I mean, there's mystery behind some of the big systematic quant funds, but macro has these phenomenal hero trades. And I think just like everyone, when they start their career, they want to be the next Warren Buffett. At some point, we want to be Soros, right? And the reality is those opportunities come few and far between. And when they're there, perhaps you really have to swing for them. But what you miss in all the narrative storytelling is all the people who swung and struck out and blew up their fund because they were in the wrong trade at the wrong time. So macro is really hard. It's hard. There's a ton of moving pieces. There's a ton of ways to express your bets. There's a lot of ways you can blow up. And that sort of dimensionality, I think, makes for really exciting trades. But as you point out, maintaining diversification and surviving until the next trade is really critical to surviving in any landscape.
Let me ask you this: as an intelligent person, isn't the swan song of macro and having a general theory of everything just so enticing that it's so hard to even keep that siren song? You almost have to plug up your ears and sail through the straits.
I'm really glad you started by buttering me up. Flattery will get you everywhere with me.
You were the intelligent one. That's why I had to ask an actual intelligent person, because it seems like intelligent people fall for this one every time.
Look, we may have even discussed this on the show in the past, but my view is that discretionary managers are simply systematic quantitative managers who go on to make idiosyncratic bets, right? The core idea here being that if a discretionary manager has a set of rules they adhere to, those rules can be codified. And if they make exceptions to those rules, and they would always make that exception, then that exception can be codified. And you can sort of do the reductio ad absurdum until you get to the point where you say any decision they make that can't be codified, therefore has to be an idiosyncratic decision. And if it has to be an idiosyncratic decision, that's what you're paying the manager for. And you're basically asking them to identify when all their rules and models are wrong. When has the world broken? And I think those opportunities come few and far between. So I'm not against discretionary macro managers. I just don't know if it's always the environment for a discretionary macro manager. I think probably most of the time they should be sort of turtled up in their long, cheap beta, give you the exposure you need to generate returns, and then really focused on where can they maximize the expression of those idiosyncratic bets of how the world is different with sort of the cheapest premium they can pay.
Yeah, and part of it too, and in Baloo asked in the comments that, don't you need a fundamental understanding of macro as a foundation to your trading basis? And my question is, you're assuming that your fundamental understanding is correct, and this is what we talk a lot about behind the scenes, is that Corey and I can actually regurgitate a lot of the global macro arguments. And what's interesting is, like, my process of consuming enormous amounts of content and everything within the financial space is I'm trying to unlearn or I'm trying to steel man ideas. So if somebody has one idea of how monetary operations work and somebody has a different idea how monetary operations work, and you see the steel man to both of those, how are you being discerning on whether they're right or not? What you're really doing is saying my subjective opinion based on my experience leads toward this person, which is fine by me. That go for that. But how could you ever know you're exactly right? Like, to me, this was really solidified. I've always thought this way, but in 2010, I remember watching, I think it was on a panel in Russia. It was Hugh Hendry and Nassim Taleb got in an argument, and they were both on opposite sides. They both had unbelievably cogent steelman arguments. And if those two geniuses disagree, who the hell am I to know what the hell I'm talking about? And that's what it's always question is, like, is there a foundation? Is your foundation of your understanding correct? But also, does it evolve through time? Like, if we just look at monetary operations, it dramatically changes whether we're on a gold standard, when we're on a fixed exchange standard, whether it's monetary operations via MMT. Like, are they printing reserves? I mean, all of these things start to factor in, and the whole entire landscape changes and evolves over time. And outside of like supply and demand, I don't know what other kind of like foundational principles they are. And with supply and demand, you can never know every parameter that goes into supply and demand even. So my point is always, like, what foundation are you building on top of? And how certain can you be in that foundation?
Yeah, I would say, Jason, I would even challenge you. So I would say that most macro narratives are not super actionable. So for example, if you think that the Fed QE is money printing or it's not money printing, you can't even, how do you implement that? The right trade is what would have made you buy Eurodollar puts and sell Eurodollar calls. That would have been the right macro narrative, is the one that made you do that. Like, it's a lot of these things about like what is, it's very interesting, and I talk about them a lot, but a lot of them are not implementable. So you have to do what works. Like, if you have a deflationary view and you're losing a lot of money, like maybe you should change your framework. Of course, this is assuming if you're a discretionary trader, which a lot of sort of retail macro traders are. A lot of people have to buy bonds because that's part of their sort of whole thing. But yeah, like just do what works and don't do what doesn't work.
Yeah, but like to your point though, like if the position's going against you and you're losing money, does that mean you're wrong, right? Just because the price is telling you wrong, is your process wrong or your actual fundamental thesis wrong? Hard to know that for certain. The second part is like you're actually agreeing with what I was saying at the very beginning is like everybody comes on these shows and has their global macro thesis, but I'm saying the best ones in the world implement hundreds or thousands of small optionality convex trades, and then in hindsight they look like they were right, where they could have just been it's entirely luck and variance. So that's what I'm more saying it's about. It's like, but then when they come back on the news again, we highlight that their global macro thesis was right. And it's like picking and choosing or golfing or fishing. Like you're making it up in hindsight, your winners versus your losers, where these guys only need to be right 20 to 30% of the time if they have a nice convex profile to the book.
Yes, I say maybe there's a parallel world in which the inflationary dynamics have been the exact same, but somehow that was good for the speculative, unprofitable technology stocks. Like in this current world that I'm in, I can't imagine that. But in some other world, inflation is good for ARK, and the Jack Farley in that can't even imagine how inflation would be bad for ARK.
Because we're trying to apply a map to a territory, and the map is never the territory. And we've talked about this before on integrating complex systems. Is like thinking that every macro thesis person is essentially a consequentialist philosopher in that they think they can determine causality. And what's even worse to me is like they're not even saying the secondary or third or tertiary causality. They're thinking about just if Fed does this, I do this. And it just never quite works that way. There's so many competing variables and contravailing forces that like how could you ever know for certain?
Jack, you know what I love about this question is the more you get Jason talking about it, the more worked up he gets, and the more just outright he just smashes on macro managers. Like he'll like dance around it in the first 5 minutes, and then by minute 10 he's like, they're all idiots.
Well, I think
they're not all idiots.
Yeah,
it depends on how they implement their trades.
I think there's a lot of quantitative macro managers where they've made 6% for the past year. They've been 6% a year over the past 10 years because they essentially they're essentially quantitative with a macro overlay. Like they're applying quantitative trading or analysis to interest rate futures and currency swaps and all sorts of stuff. Like that doesn't mean that they're like they wake up in the middle of the night with an itch on their back and they're like, I'm gonna go long the dollar.
Yeah, that's what I'm saying. Like they're essentially long leaps. Like that's what the best ones are.
And you can introduce macroeconomic signals into your quantitative process, right? Does that make you a macro manager? I think narratively, most macro managers have some sort of strong view. I think that's what we're used to, right? They're talking about how the world is breaking and there's chaos and how they can create outsized profit. I think the reality is most people, even in the quantitative space, incorporate some aspect of macro when they're active, but it doesn't necessarily make you sort of the generic macro manager. So there are plenty of systematic macro players out there. They're just, they're looking at lead lag relationships across different central banks or inflation responses, or right. They're incorporating all that information. They're creating GDP now models, and they're trying to use that. I don't think there's anything wrong with that. That's just a very, very different type of macro.
I'm probably someone says who's smarter, Corey or Jason.
This is not even a competition that I'll put it this way. I'm flattered to be in that question. That's how it's not even a competition.
That's not true at all.
I'd also say, and this is, I'm curious if you guys disagree with this, is that if a regime works today, a narrative works today, it may work tomorrow. Like if in January of 2022, being long energy and being short ARK, that worked, like, interesting. Maybe it will work in February. In the same way that like if volatility
narrative reflexivity.
Narrative reflexivity. Boom. I gotta save that for a title for Pirates of Finance in like a month.
No, we had
first of all, it's Pirates of Finance.
Yeah, finance. You're right. Yeah.
And Jack is saying that because of persistence. That one of his guests was it Howell was talking about the persistence of signals. So we're on to Jack. We know that his questions come out of his most recent guest.
Oh, did he really? Michael Howell said that? What do you mean?
he was talking about like even like inflation persistence. Like the next month is likely to be a 0.8 beta to the previous month, the following month 0.6 beta. Like that, there's a persistence in a lot of global macro numbers.
So you're right, he did say that, but I talked to Noel, and the reason that it came to my mind was because Noel was saying that, you know, if realized volatility for this week has been 35, you know, next week it's probably going to be 34, so somewhere it's not going to be 5. You know what I mean? Like volatility is, I forget the word. There's a fancy word that I've heard
clusters.
Corey say on his clusters. Yeah, exactly.
Well, and this is a great point though. Not only does volatility cluster, but volatility also mean reverts. So good luck picking which one we're in.
Yes, but wait, how could something cluster if it also mean reverts? It must be a different timing. It must be
different time horizons.
Exactly.
And cluster in the short term and mean revert over the long term.
Yes. Okay. Okay.
So Jack, sorry, one last thing, because I know we've gone too long on this, but Corey and I have actually talked about this a lot. This is really interesting. Is if you had a properly diversified portfolio where you held almost all of the world assets, right? But then you said, I'm a discretionary global macro, and maybe all those global world assets where you put a trend following overlay on it, then in hindsight, you could say you called like every move. But if you said it was a black box and you're global macro discretionary, you could basically get on every news channel on the world and just and point out your highlights and never talk about the losing trades.
Yeah. Or you could do like, you could make 7 trades, you know, you could trade coffee like 7 times a day, and then one of those trades is going to make 20%, and then you can be like, hey, I made 20%.
Yeah, it's like an old school like chain letters. Like this is what I'm saying is like the managers that get this wrong, they don't come on your show. You're not looking for them. So there's this survivorship bias of like the ones that have flipped coins right a few times in a row. They're likely to be on your show, and then that cascades to other shows. So there's a persistence trend to financial media.
Right, and someone who's been down 70% this year, I probably don't want them on my podcast. Podcasters don't want them shows, and they don't want to do media because they've been, you know. But people who are up 100%, they're like, yeah, you know. So the time that
except for Kathy, everyone's still dying to get Kathy on their show. There's always an exception to every rule.
True, very true. Let's see. We got a question from Balu. It says, speaking of math, do option makers use models or do they just watch supply and demand?
Both. Depends on who they are, right?
Yeah. I mean, I will tell you, one of my good friends leads up systematic trading for Citadel in their option side, and they have models, right? What they're effectively trying to do is look at the curve, fit, and then see what is out of whack, and they're, you know, changing where they want to be offering, you know, where they're doing their bid and ask based upon their own inventory as well as what they think is out of line on the surface.
Yeah, without Corey and I getting into some compliance issues and outing people or whatever, it's like it's a little bit of everything. Most people will have theoretical models like Corey's talking about, and we've talked about this on past episodes, where they're overlaying their theo models with what the vol surface is giving them and looking for mispricings there. That's what a lot of them do. But a lot of them can be looking at relative value, whether that's, you know, within an asset class or cross asset class relative value. So it's a little bit of both, really. Is like, and whether you need the math or the models is what you base your trades off of, or you're looking for other potentially disturbances in the force, to give everybody a hint.
I like how you say, to give everyone a hint, and you use the most generic Star Wars reference, hoping they know exactly what manager they're talking about.
Well, if they're obsessive about listening to your podcast as I am, then they'll know exactly what I'm talking about.
And this person may be coming up on Jack's podcast. So keep your ears tuned.
Oh man. Okay. Well, can I plug who's coming up on my podcast?
Go for it.
Okay. Yeah. So Ben Eifert, that is airing
on
Monday. And Noel Smith is airing shortly today. And Noel Smith, he gave me a fantastic question, but I want to save it towards later. The first thing I want to ask now, Corey, is about technical indicators, and in particular RSIs, relative strength indicators. If it's below 30, it's oversold. If it's above 70, it's overbought. What does that mean? How can it actually be used? Is it BS? Yeah. How legit is it?
Yeah, I'm gonna back up and not talk about RSI in particular. Maybe let's talk about technical analysis in general. So I think there's the general perception that technical analysis You either believe in it or you don't, right? I find that it's very polarizing. People find it useful, or they think it's basically astrology, not to insult astrologists or anyone who believes in that. I sort of land somewhere in the middle, where my view is that there's a couple potential outcomes. One, if there's sufficient people who believe in a certain form of technical analysis, it can become a self-fulfilling prophecy. You see in markets round number effects, for example, because people happen to like trading at round numbers. You see that strikes tend to be around round numbers, which can invite pinning in markets. And so there are certain technical things that can become self-fulfilling because of a behavioral bias or a joint belief. So that's one aspect. The second aspect of technical analysis is there are some indicators that are tied to some quantitative models. So, for example, moving averages are something that are used in trend following pretty frequently. It's just one way of measuring a trend among many. I wouldn't necessarily say you can have a black and white rule like the 50-day moving average falls below the 200-day moving average and you need to get out. The death cross versus the golden cross in equities, like that's a big single trade, whereas trend following typically is diversified across 40 or 50 futures markets, different asset classes, different time horizons, and different models, right? But there is that sort of theoretical attachment. RSI, for example, when you run it across a large number of securities at the same time and rank them, you are doing something that's a close cousin to idiosyncratic momentum, which is a somewhat popular form of quantitative momentum. So again, these things aren't totally without basis. I think what doesn't work is when you use them in isolation and as absolute rules, right? I think that's where you can get into trouble. And that has less to do with them being fundamentally broken and more to do with just taking a large bet on a single signal. And that's sort of the issue. I will say finally, there's been some papers out there, and I can't come up with them off the top of my head, that have actually sort of identified that there are a large number of technical signals that are really just degenerative statistical models. So again, you can sort of look at some of this stuff and say, on its own, maybe you don't want to trade the market when RSI is above or below a certain level. Like that's sort of meaningless. But if you think of, say, ranking the RSI of 500 stocks and picking the top 100, well, you have something that looks pretty damn close to idiosyncratic quantitative momentum. So again, these things aren't totally without merit. I just think you need to be thoughtful about how they're applied.
When they're all a rear view mirror based on whatever time horizon you're looking at. And quite frankly, it's looking for a probabilistic signal for you, right? Like do you have a higher probability of going short or long based on whatever time window looking your back that you've overlaid this signal on? So once again, could you be getting into curve fitting or just a time framing issue? So that's one thing with RSI. I think the one that I think Sean asked about, what our thoughts on like Tobin's Q. I'll even throw Buffett index in there or Schiller index. All of those things are trying to give you a probabilistic understanding of the world. And, so a lot of times those things, any sort of indicator works until it doesn't work. So, you try to use these things to give, probability. The problem is a lot of times you're using it to ballast your own thesis. So you got to be careful of that. But part of it too with the RSI indicator, I thought this was great too, is like RSI works as long as you have a mean reverting asset. If it's going to zero and it's oversold, like what is that telling you?
Mean reverting on the time horizon that you're measuring RSI.
Right.
You got to get a lot right there.
Because I'm sure Terra looked oversold as it was going to zero. So
well,
like,
I think
what is it?
I think this actually comes from, Jack is digging this from a tweet that I did earlier, where I actually retweeted. I took a screenshot of a fairly well-known crypto Twitter account talking about basically throwing shade at the RSI and saying just because the RSI is low, that's not going to stop people from getting capital calls and margin calls and liquidated, which is happening like crazy in the crypto market right now. There's a massive hedge fund that just blew up. I think it's like an $18 billion hedge fund that's basically bailing out on all its margin calls and not calling people back and not delivering capital where it's needed. So credit's getting sucked out of the system like crazy, right? Your RSI, like it's not like the market needs to adhere to the RSI being low. Like there are fundamental drivers of liquidity that can make it go far lower. And if you're unaware of those things and you're blindly trading something like RSI, right? You're trying to trade a statistical model at a time that statistical models don't matter.
Yeah, I want to front run Captain Jack though. Please don't ask us about cups and handles and saucers and all that stuff next.
Oh yeah, no, I definitely won't. I think that the concept that often technical analysis is a more crude, more old-fashioned way of quantitative analysis that like the quants do nowadays is interesting, such as if something's below moving averages, it's a short. If it's above, that's just trend following.
Right.
And then, Corey, I have a question. You said that RSIs are a form of something quant something. Like what were you saying?
Idiosyncratic momentum.
Yes, idiosyncratic momentum, but wouldn't momentum be it's going down, so short it? RSI is it's gone down too much, so it's not a short.
Isn't RSI the relative strength indicator?
Yes.
Yeah.
Right, and so there's a couple of ways of measuring RSI, but I believe one interpretation is you're measuring it versus, say, a benchmark like the S&P. And so if I were to take 100 stocks and calculate their RSI, momentum would say buy the ones that have a high RSI, they're outperforming, and that would be sort of idiosyncratic momentum, less quantitative, right? You're not backing out the actual beta, and you would go short the ones that are underperforming. But you could go the other way and say, well, over this horizon, I actually don't believe in momentum. I believe in mean reversion. So I'm going to reverse the sort and trade the opposite. Maybe it's a short-term RSI instead of a longer-term momentum, and then sort of idiosyncratic mean reversion. So like, just because the indicator might be 70, right, or whatever, or 30, doesn't my interpretation of that indicator could be different than yours based on the horizon I'm trading it, right? You might say 70 means short. I might think 70 means it's going to extend to 90.
Yes. It's tough. I think on the periodicity of what is the typical one, 14 days. 14 days, which is like almost 3 weeks for trading days. It's above 70 is like it's getting a little hot here, and below 30 is whoa, this is oversold. Like for example, like Berkshire Hathaway I think now has an RSI of like 20 or something like that, and that is a sign that like maybe it's maybe it is oversold, and Berkshire Hathaway could be in a bear market over the next year, but over the next few days like the selling pressure is sort of exhausted, so like I feel like a lot of short sell, I feel like, I don't know, but like I talked to like Vincent Daniel and Porter Collins, who were, worked for Steve Eisman, and they said like if the RSI goes below 20, cover your short, and then wait for it to rally like up a little bit, and then once it rallies, then you short it again.
Yeah, I think rules like that are hard unless you're doing it with great breadth, right? I think a lot of like the nuances of, is it below 20 because there's systematic liquidations and it's going to go further, or did the systematic liquidations already happen and therefore it's likely to bounce back? A lot of that nuance, if you're going to do this on a one-off basis, you really need to look for the fundamental drivers and understand the liquidity. Understand, did it sell off because it had a horrible earnings call, like it's fundamentally repricing lower and it's now at a lower price justifiably, right? A lot of that can be ignored if you're increasing your breadth cross-sectionally. So you're doing it across hundreds of stocks at once. The stuff that you got wrong, but covering your short too early, will sort of average out with the stuff where no, you were right to cover your short early. And then as long as you believe that concept as a whole has some alpha to it, right? If you believe that indicator has alpha. But a lot of this stuff, I'm sort of the view of like what quants do differently than fundamental managers, in my opinion, is that quants try to fix everything with breadth, where we take a trade expression and we do it across a lot of stuff at once, a lot of different models, a lot of different markets, so that we don't have to know the individual specifics, and we use that diversification to get rid of a lot of the idiosyncratic risk, where fundamental or discretionary managers are typically diving in to understand the mechanics of a particular market or a particular trade that allows them to identify perhaps when a model doesn't apply.
Boom goes the quant. Mic drop.
Mic drop. There we go. All right. My another question is about what Noel Smith said to me, that volatility veteran. He said that J.P. Morgan. Some people don't care about mentioning the name. Some people do. There's been a collar put on where essentially they sell a call and they buy a put spread. So they buy a put spread here, and they buy a put here and they sell a put here, so they get that protection in that zone. The S&P has gone down to here, so that asset manager is now short these puts, and the market making community, Citadel, option, people who create options and stuff like that, they are long tons of puts, and they don't have a view on the S&P 500. So when the S&P 500 goes down to its maximum gamma zone, which according to Noel is something around 3620, very close to where we are now, they are buyers because their exposure is going up. So to what degree is that I assume it is accurate. That is true. But how should people be thinking about that? How actionable is that of a trade?
I'll start. I'll jump in a couple of things on that. One is, and Jack, you described it well. The JP Morgan hedge equity is a 800-pound gorilla. It is a big trade, but it's not the only trade in the universe. So where dealers are positioned relative to that trade does hopefully give you a little bit of information, but compiling information how everybody else and all dealers are positioned outside of that is more exceedingly difficult than just knowing where that trade is. And then even if you know where that trade is, if you've been following that trade, they're getting pretty good at masking a little bit. They kind of keep changing the rules, and they'll kind of put on different positions going into the trade or during when they have to roll the trade to throw off the marketplace that's trying to front run them. That's about kind of all I have to say about it. I'm sure, Corey, you might have a more nuanced opinion there.
Yeah, I believe they're about 18 billion in assets in their primary fund. I believe every 3 months they are end of quarter rolling a put spread that's 5%, struck 5% out of the money, with the short leg 15% out of the money. So I think you do get this interesting dynamic, Jack, that as you start to move into those puts, into that put spread, the dealers should be getting increasingly short. And then as you go out the other side of that put spread, they're actually buying back because they're decreasing. They no longer have that short exposure. So it's this increase. It's this like increase of potential volatility, and then as they exit through, it becomes more and more supportive until it sort of diminishes. So I think it can potentially help buffer markets if it is that big a trade. To Jason's point, though, this is a well-documented trade. It's written about every quarter, and market makers aren't necessarily the only people on the other side of this trade. You've got a lot of people who know about the rules of this fund, can calculate precisely where on the volatility surface, what strike this fund is going to roll to, and is trying to take advantage of that fact. So you don't necessarily always have market makers on the other side. You could have people trying to be relative value traders, trying to provide liquidity to JP Morgan by taking the other side, and who may not be necessarily delta hedging, right? So to assume it's all 100% getting delta hedged, that's up for debate. But certainly there are potentially some interesting gamma dynamics that this massive trade brings into the market. And I do think this is talking about sort of the evolution of markets. Markets are never the same. They're always something new, something happening. I think the evolution of the options market is certainly something that makes today's market very different than 15 years ago. I'm sure some people would contest that, but I think it's getting larger and larger and potentially having a greater impact. But I would also argue there's more players to try to exploit that impact. So you could potentially have it becoming more efficient and potentially less impactful depending on how they're exploiting that trade.
And then to piggyback what Corey said, that I thought was interesting about on the put spread side, when you're thinking about the dealer hedging on that put spread side, like Corey was describing, you have this unique hump kind of to like the volume of their hedging and how it's going to accelerate and then decelerate because it's a put spread. And what that's semi-analogous to is the structured product world. And we don't have we may have good insight to what JPM is going to do on this hedged equity, but we do not have good insight into the structured products. But what's interesting about the structured products, just like when they're hedging a put spread, is they're going to accelerate that hedging as it's getting to the strike at the bank level, and then they're going to completely take it off because it's getting put back to the customer. So once again, you have a very unique kind of hump in the volume of that hedging going in and going out of that trade, depending on where the underlying delta lands.
I want to say this is something that I think a lot of people get really confused about, especially if you don't trade options, trying to figure out what way is the dealer hedging for a given options expression. The way I think it's easiest to think through this is to just say, if I'm buying a put I'm effectively shorting the market. I want the market to go down. And by buying the put, I am pushing that trade expression over to the dealer. They are going to be forced to short the market on my behalf. If I'm buying a call, well, I ultimately want the market to go up. And so by buying a call, I am pushing that trade expression onto the dealer, and they have to buy to hedge when the market goes up. So I think that's sort of the easiest way to think about it. And so when you think about the put spread, it's, yeah, okay, I'm short up to a point. And then at that end point of the spread where I'm now short, I'm effectively taking my short off. So I'm short through this zone and I'm taking my short off. Well, taking your short off, right, is effectively monetizing your put in a way. And you can think of that as buying back stock. So when you take that short off, when you buy back that put, or you get to that put spread point, if the dealer is hedging, that is ultimately supportive. That's a supportive point in the market because they are buying back all that short position. So I found that to be sort of the easiest way to think through how the dealers are hedging. Just think of it as, if I'm long a put, I want the market to go down. I'm pushing that short expression onto the dealer. Where would I buy that back? Wherever I buy that back, that's ultimately where it's supportive to the market. And if I'm not buying it back, they're ultimately exacerbating the move to the downside by having to short more.
Captain Jack. Did we lose him?
There we go.
There
Sorry,
he is.
it took a while. So I just did post in the description my interview with Noel, but do not watch that until we are done with Pirates of Finance.
It's already cross-posting content.
Yeah, exactly.
Cross-pollinating. I think, let's see.
We did. What did you just figure out a rate that we're going to charge Jack for all this advertising on our show?
I know, right?
Yeah, that's true. You want to talk about what's going on in crypto? 3 Arrows Capital, Celsius.
I actually do a little.
Yeah.
Because I think it's really, well, A, it's an interesting case study. B, I do start to wonder how much this is going to bleed over into traditional markets. Like I think we've long sort of talked about this point of where is the spillover. For those who don't know, 3 Arrows Capital is a hedge fund that was run by primarily two well-known gentlemen in the crypto space. I think they were managing 18 billion. And they seem, one of the things, and it's all very murky right now, but basically news started to come out that post the Terra Luna crash, they stopped basically meeting margin calls. And they were working with, borrowing from folks like Gemini. They were borrowing from folks like Celsius, I guess, and BlockFi. They were on the other side of a ton of these trades. They were offering treasury management services to a large number of protocols. So this huge hedge fund of theirs has now seemingly imploded and is having meaningful knock-on effects into, more I don't want to say traditional, because it's not like a huge proportion of people are, lending via BlockFi or lending via Gemini's desk or Celsius, but certainly having a knock-on across the entire space. And one of the reasons we've seen some violent sell-offs in crypto over the last week has been because of these forced liquidations, which have cascading effects as other market participants get forced liquidated as well. So on the other side of that, I think we saw A16Z launched in like 2 or 3 weeks ago, a huge new crypto hedge fund. So it'll be interesting to see. I think crypto is still a space that largely survives on leverage and credit. And this is a huge vacuum effect for leverage and credit. And I don't know what it's going to take to get the players back in the casino. This might be sort of a real winter, or you might see an opportunity for people like A16Z to start scooping up some projects really cheaply, because you had one of the things that 3 Arrows Capital was doing was making private investments as well. So that'll all be sold off. And I think what they're trying to do is basically prevent 3 Arrows Capital from dumping the tokens that they earned of those projects and trying to sell off some of the equity in those projects with the tokens hand in hand. So things are flying fast. I'm hearing rumors in all my sort of chat groups about the craziness that's going on here, but certainly one of the biggest players having one of the biggest cascading effects in crypto right now.
Corey, I wonder I don't have necessarily anything to add to that specifically, but like if we start adding them all up, we're getting close to maybe 100 billion evaporated across, Terra Luna to Three Arrows to Celsius, like we start adding that up, it's like roughly $100 billion. And at what point does that cascade into traditional finance markets? And what I mean by that was like, we talked about the 99 bubble tech stocks and everything, but the nice part is that's equity bubble, right? It wasn't a debt or credit bubble. It tends to kind of really blow up the general economy. And then the recession from 2000 to 2002 was a fairly, mild or benign recession on the consumer side, let's say. So, and then in hindsight, we like to point out these canaries in the coal mine. Like I think about the 2008 GFC, people will point to like the quant quake or the rumblings that happened in mortgage markets in 2007 and be like, see, the writing was on the wall. So I'm wondering in 5 years hence, like if people are going to look back and saying, $100 billion worth of crypto getting liquidated is what led to a negative 50, negative 60% drawdown in S&P or something like that. But it's going to be a nice hindsight bias in the future. But like, I think right now people don't think there's going to be real reverberation effects, or maybe we've seen the reverberation effects in the S&P. And, if we want to use spurious correlations, right?
Yeah, I think typically people expect there to be spillover effects when you get a new asset class being incorporated in broad asset allocations, right? So I think the most recent example of this was the early 2000s, where you had commodities getting adopted by a huge swath of the institutional community. And there's a lot of evidence that correlation between the larger commodity markets and the S&P became more positive during cascading events, that basically people were being forced to sell commodities or forced to sell equities as collateral because they were all part of the same asset allocation. I'm not sure crypto ever got there, right? Crypto.
And does this delay that though too? Does this delay the institutional cascade, do you think?
Yeah, I made a joke on Twitter. I mean, I don't think we're getting a Bitcoin ETF anytime soon, right? Part of that's just appetite. How many people just blew up? How many people that were long crypto over the last couple of years just lost a ton of money and are just going to say, you know what, I'm done. I'm not putting any more money in the casino. In many ways, crypto remains a liquidity-driven asset class. There's a lot of the fundamental cash flow is not there. And so you don't get that fall back to gravity. It's not as easy to say this asset is undervalued relative to other assets because a lot of these tokenomics are designed specifically to avoid securities laws. So you don't have associated cash flow with these things necessarily. And that's not true for every project. You can look at some projects and say there is a treasury that's worth something and the DAO can vote on it and blah, blah, blah. But it's not as easy as me saying, I think I can project the cash flow for equities, even with a huge, wide confidence band. This is an attractive valuation for the next 40-year horizon I have to invest over. I don't think it's that easy with crypto. And so without that fundamental gravity, I think sentiment drives a lot more than you see potentially in other asset classes, where sentiment still drives a lot in most asset classes. But I think crypto, it's like credit, liquidity, and sentiment all tied together. And if you get enough people just walking out of the casino, it's hard for a casino to keep operating. And I don't say casino, by the way, in like a degenerative way. I mean, I like Lee Drogan's phrase, the casino's the boot program. You need this casino to get liquidity in the system, to get these protocols up and running so that crypto can figure itself out.
I was going to ask, when this kind of relates to some of Jack's earlier questions, is like, what do you wait to see before you'll like start DCAing back into like Ethereum? Like, what do you really like to see for liquidations, blow ups? Not that you're timing the bottom, because like that's implicit at DCAing into it. Is like, how do you think about that in general?
Yeah, so I sort of stopped putting money in 8 or 9 months ago. I said, okay, I've sort of put enough in. I think it's getting a little hot. I didn't take anything out. I sort of keep everything ETH denominated. By the way, this is absolutely not investing advice. But from the perspective of when do I start to DCA, I will tell you I have started thinking about it now. I don't think we've necessarily seen the end throes of this Three Arrows Capital situation, but that doesn't mean it's not already priced in. I think there are some potential liquidation events still. I think there might be some interesting ways in which you can do some long shorts that might have more attractive upside, even if the market keeps going lower. But I have sort of said, okay, would I consider DCAing in over the next 6 to 12 months? You know, how low can this thing go? I will say for the stuff that I've just kept long ETH, and people will probably really roll their eyes here, I do think that there are certain NFT projects that have long-term upside if ETH recovers, right? That these projects aren't going anywhere. They tend to be, I'm going to call them blue chip top 10 projects that have sold off dramatically. And there are some of them where they've sold off dramatically because there have been forced liquidations, that people were levered and then needed to liquidate their NFTs. And they're an illiquid market. So when you liquidate in an illiquid market, that sends the floor down dramatically. If you can start to pick up some of those pieces, if you believe that ETH is going to recover, I think some of those top 10 projects will recover and more, you know, because you're sort of staying in the same denomination. So I've done that with, I don't know, a quarter of my ETH, not that much. I'm still being very patient there and trying to pick my spots, recognizing that probably most of it will go to zero. But this is sort of more fun money for me.
Well, and definitely not investing advice, but it kind of like boils back to what we were saying about global macro traders is the micro institution of the instrument. And like you're just saying is like certain NFT projects are a leverage way of getting ETH exposure without taking on some of that leverage that you may get capital call on. And so yeah, it's a leverage play on ETH. But part of that is I wonder, and what non-investment advice, you and I are always texting each other about this stuff, but like if Tether depegs, which should lead to an incredible liquidity cascade across crypto, or maybe less so now that everything has already happened, is that an indicator to you of when to start really buying in, or is that just evaporate the whole market maybe forever?
All right, so take this the other way. Yeah. If Tether depegs in a bull market, Tether is getting used as the stable coin by which all the leverage is being applied. And so it would unwind, right? You get margin calls on all the longs. Right now you have pressure on the short side because we're in a bear market. So if Tether depegs, it's the shorts that are going to get the margin calls, and you could actually get a massive short squeeze in a significant Tether depeg, which I think is sort of the opposite of what people expect.
Of Bitcoin to Tether, but not necessarily Bitcoin to like a dollar bill necessarily.
No, you could get a Bitcoin to a dollar bill because people are going to be forced to buy back Bitcoin and not necessarily sell down Tether further.
Right, but then if they're forced to buy back Bitcoin, and then but then they're running from Bitcoin to a dollar to cash, like then like it's both, right?
Well, they're not running from Bitcoin to a dollar. They're just covering their short.
Right, but covering that short and then Bitcoin, and then if you're fearful enough, you're going for actual cash.
Yeah, but once it's covered, they're already in cash.
Yeah.
Because they were short. So it's not like, I guess what I'm saying is like the pressure, right, is to the short side right now. If they're all forced to buy back, it's a short squeeze. Because the collateral they're posting went down. So think of it this way, like Jack, like don't think of Tether as a dollar. Think of Tether as like, what if I'm long Bitcoin? What if I'm short Bitcoin using Ethereum as collateral? Mm-hmm. And Ethereum loses its value. I'm going to have to potentially post more Ethereum, or, right, so people could buy more Tether, which might drive it back to peg, or I need to cover my Bitcoin short, which would drive up the value of Bitcoin, regardless of whether it's to Ethereum or not.
But it would Bitcoin relative to a Tether, but how would Bitcoin relative to like USDC or a stablecoin that's...
Ignore what it's relative... The Tether is just what's being like used as collateral. So ignore Tether for a second, right? That's why I'm using the Bitcoin to Ethereum. If I'm short Bitcoin using Ethereum as collateral, and Ethereum goes down, and I no longer have the collateral to support my short, I need to buy back the Bitcoin.
Yeah, covering.
Right?
Yeah.
And that Bitcoin's going to get bought back in dollar terms. It's all priced in dollars.
Yeah.
So it doesn't matter what
short squeeze. Yeah.
It's just a short squeeze. It's just a short squeeze. It would be, and you'd see it across all, sort of all assets. So what you could see in this scenario is that people say Tether, a depeg of Tether would take down the system. It might in the long run, but in the short run, you could see a violent short squeeze to the upside relative to the dollar in Bitcoin and Ethereum, as all these short sellers are basically get margin calls.
I want to close with something, just an observation. I probably shouldn't be saying this, but just like, I watched a movie last night which was so horrible. It's called Gaming Wall Street, and it's about GameStop AMC.
Yeah.
It featured as a narrator Kieran Culkin, who's like the Roman character from Succession, who I actually like a lot. But it's just like, I mean, it's just really. I would not recommend watching it.
So I haven't seen it. So what didn't you like about it?
Okay, I'll just give you 3 moments. Okay, number 1 is when someone said it's going to moon, and they freeze framed and put on like in text moon when something goes up a lot. That's moment number 1.
Okay,
moment number 2 is they unironically.
Hold on. My father would not know what it means to moon, other than pulling your pants down.
No, he said it's going to go to the moon. Like, your father would know what something means to go to the moon.
He could probably figure it out. He's a smart guy.
Yeah. Okay. And then also it unironically featured a clip of Chamath talking while it was all happening and being like, this is because of 2008, because of how unjust the banks were and the whole system. And it's like, dude, look at how those SPACs have performed. Like, talk about someone who is, not done well by the retail investor. Like, the producers should know that. And then, I mean, yeah, it featured scenes of like, very like, poor, like desperate people like buying GameStop at the absolute top. And that is, they did tons of damage.
I had a friend who texted me in January 2021 and said, I just bought 1 share of GameStop because I really want to stick it to Wall Street. I said, you didn't stick it to Wall Street in any way. This is someone who really does not understand stocks and bonds, and it's not part of their life. They don't think about it. It's just not how they have gone about their life. And so he just sort of heard that this was how you stick it to Citadel and Wall Street, and his 1 share was his revenge. I was like, you did nothing. That was the most meaningless thing you could do. And it is sad because it's a financial education issue. Now, to that point, I think this brings up an interesting, bigger picture issue, which is one of my favorite things to talk about, which is Gelman Amnesia, which is this idea that when we're going through, let's say, the newspaper, and we read an article where we don't know any of the subject expertise, we tend to accept it as fact. And then when we flip the page and read an article or watch a documentary about something in which we are an expert, we're pointing out flaws left and right. But we don't seem to connect the dots that, like, it's not that this one thing is wrong, it's that probably all of it's wrong, and we need to stop accepting things at face value. So to me, it's just a perfect example of like Gelman amnesia writ large, and it's something I've tried to accept in my life. If anyone has had the good fortune of having an article written about you, and you read all the things that someone writes about you, and you go like, this isn't true at all, and then people start accepting that as fit, you really become intimately aware with the concept of Gelman amnesia.
I would say though, it's not as if like it's a weatherman, weatherwoman who's on TV, and she's saying it's going to rain tomorrow, and I'm a weather expert who has my PhD in meteorology. I'm like, he's not talking about the La Nina Mordecai. Like, come on, the rain cycle is going there. It's not like as if it's not just that they're dumbing it down or simplifying it. It's that they're making a bunch of key assumptions that I think are incorrect.
That go find any article in the newspaper and go find an expert, and they will tell you about all the key assumptions that are incorrect. It's just, unfortunately, the reality is you can't expect most people, like anyone who's making a documentary, even if they're trying their hardest, and I will give them the benefit of the doubt, they are not experts in finance. Who's that one person that happens to be an expert in finance that decides to make documentaries? Like,
Nobody.
The cross section is so small, so you end up with someone who's maybe tangentially interested or thinks it's a timely piece that just doesn't have the sophistication to know that what they're saying or what they're putting out there just isn't factually correct.
This is great. I'm going to tie it back to like the beginning of our conversation too, because I'm glad Corey brought up Gelman Amnesia. But Jack, I'm with you in the sense that like I watch a ton of documentaries, like thousands of them. This was a poorly made documentary, but like to Corey's point, I hate to judge art. Somebody spent a lot of time on that. So like, respect to the amount of time put in, but at the same time, I'm with you. Is like, Kieran's character Roman on Succession is phenomenal, but then having him play that character to a narrator didn't work either. And then, like you said, I turned off after 15 minutes because it just made me sad seeing people living out of their car and still trading GameStop. Like, it was just sad. So like that's why I didn't want it. But like Corey is perfect with the Gelman Amnesia. Is like, that's my favorite one, combined with Dunning-Kruger. And Dunning-Kruger is the idea that, like, as you're learning about something, you think your knowledge is, you understand it better than you do. Then you go through a trough of despair where you don't think you know anything. And then usually the experts, then they underestimate how much they actually know. And so to tie this all back into global macro with Gelman Amnesia and Dunning-Kruger effects is like, if you are watching anybody on financial punditry and you know, whether it's on any sort of channel, and you're watching them for 15 minutes or an hour and then thinking this is what you're going to go trade off, that's insane. Like, to me, it's like, it's the reason why I hate TED Talks. To watch a 20-minute TED Talk and now think you're an expert on a subject, instead of thinking, oh, this is the door that opens up the you know, get my foot in the door. So now I can spend 2 to 3 years trying to deep dive on the subject to see who's full of shit and who's not, and what are my own personal opinions. But that's the way society is. Going back to Corey's Gelman Amnesia, everybody reads the headlines and thinks they're educated. They don't realize how misinformed they are. Same with people that watch TED Talks. That 20-minute TED Talk did not make you an expert. The same as watching anybody talk about global macro for an hour does not make you an expert on monetary operations. Like, this stuff takes years for you to realize who's full of shit, who's not, and where your own personal subjective biases will skew towards.
Can I just point out the irony of the fact that the Dunning-Kruger effect was written about last December and potentially proven as being not a real effect in the data?
That's even better.
The original paper might have some data issues.
Wow. That's interesting. Yeah, I want to say about critiquing art, Jason, you're absolutely right. And I think that the producers, the cinematographers, the video editors, the graphic designers, I thought they did a fantastic job. Particularly some of the motion graphic designs were great in that film. The editorial is what my critique is focused on.
Right, but also
that I will not withdraw.
In fairness, I cut out your legs from under you because good television is shitting on everything, right?
Yes.
Well, with that, you want to call it an episode?
Sucks. That's why the show sucks.
Everyone, this is Pirates of Finance. We thank you for tuning in. Whether you're here live in the comments section, we appreciate you, or you're catching us later on YouTube or Spotify or many of the other podcast platforms, we appreciate your time. I'm Corey Hoffstein. That's Jason Buck. That's Jack Farley. We are on Blockworks. We are here every Friday. We hope to see you soon. Thank you for your time and enjoy your long weekend.
Thanks. Enjoy it.